Mr. Gopal Krishna, Mr. Sarvade, colleagues from the banking industry and Reserve Bank of India. At the outset, I think let me compliment Kafral for organizing this international seminar on cyber risk and mitigation for banks and financial institutions. This is a topic which has assumed center stage not only in India but globally, as we keep on hearing from various incidents. As regards cyber risk, I think as John Chamber, who was the former CEO of Cisco, he famously said that there are only two types of organizations. There are only two types of organizations in the world. One who have been hacked and others who don't know that they have been hacked. There is no other third kind. And I think this makes it quite relevant, as Mr. Gopal Krishnan was mentioning in the opening remarks. The information sharing, a platform so that people can learn from each other's experience. I know there are hesitations, there are reservations to divulge or share the information. Sometimes even within the organization it takes very long for all those who are stakeholders to know about it, but I think time has come that we need to give a serious thought to it. When I looked at the schedule drawn by Kafral, I find that it's quite comprehensive, and I'm sure that the participants would benefit from both the presentations as well as from the mutual deliberations and sharing of their unique experiences on the subject. In my address today, actually I want to broadly cover two dimensions. Is not only the cyber risk, but both are in a way interrelated. That is the one is internal information technology security, and second of course is the network vulnerability in banks. Broadly that is what I intend to do. Now let me begin by tracing the evolution and adoption of information technology by banks in India. Of course, many of you already know, and you know that Reserve Bank of India has played an important role in the technology adoption by banks over the period. In fact, Rangarajan Committee on Mechanization in Banks 1984 could be considered as the beginning of adoption of technology for Indian banks, and those of us who have joined bank much earlier than that, I think we have seen that journey from the manual ledger, when by the end of the day you feel that you have done a good round of weightlifting throughout the day, lifting those heavy saving bank and current account ledgers from counter to counter. Thereafter, various committees, working groups have recommended gradual adoption of technology in the sector, and it all started with what was known as ALPM, automated ledger posting machines, then migrated to total branch automation, and finally to the core banking solution as we see them today. An agreement was reached with the Employees Association to initiate computerization in public sector banks in the 1990, when the new generation private sector banks came, and they commenced their operations in fully computerized environment. Basically, as Moore's prediction of doubling of overall processing power of the computers every 2 years kept coming true, and you can very well see it in the banking industry. More and more applications in the banking space got pushed to the computerized environment. RBI also played a pivotal role in developing the payment market infrastructure and facilitating use of technology in the banking sector by setting up institutions like IDBRT or the NPCI or the CCIL, and you are well aware, in fact some of you represent those organizations, so I don't go into the detail that what do they contribute to the PMI. Now going further, Information Technology Act enacted in the year 2000 gave a further fillip to conducting of transactions in a computerized environment by providing a legal basis for the same. internet services gained roots and that led to limited internet banking services. The exponential growth of mobile phone users in the country has also fast-tracked their usage as a delivery channel by the banks. The latest in this long line of innovation in the banking technology space is a unified payment interface as recently launched by NPCI, which has pushed the boundaries on remittances. Now, to cut a long story short, technology adoption has increased manifold, and today no bank can survive without robust technology, customer-friendly digital products, hassle-free user experience, and continuous innovation. Now, with the advent of fintech-related innovations across the globe, well-established banks are challenged once again. Today, most of the banking needs could be managed through your mobile. Card-based payments also have matured with the advent of prepaid card, tap and go, virtual card, multi-currency card, QR code-based payment, etc. But technology has moved from an enabler and differentiator to bare necessity and way of life. This needs to be recognized. By end of this year, a handful of payment banks would have commenced their operations. In fact, a couple of them have already commenced their operation. So that will be stretching the banks on technology front. Some technological advancements that have already made a foray into financial sector are knocking at the doorsteps, including big data, artificial intelligence, blockchain technology, and Internet of Things. Now let me just mention a few examples to give a sense that what kind of banking space we are increasingly looking into. The Banking Santander has announced that it would provide secure transactions using voice recognition via its banking application. RBS, Royal Bank of Scotland, has trialed Lugo, an artificial intelligence customer service assistance to interact with staff and potentially serve customers in the future. SoftBank in Japan, in collaboration with Paris-based robotic experts, Aldebaran, has developed Pepper, the world's first humanoid robot. Pepper is already being used in customer services industry as a replacement to an informational booth or the welcome desk. Mizo Financial Group Bank has also introduced Pepper to its flagship branch in Tokyo in the year 2015 to deal with customer inquiries. While Mitsubishi UFJ Financial Group has trialed now a humanoid robot to interact with customers. So you can see the trend is increasing, and taking cue from their Japanese counterparts, I understand that very much in India, SDFC Bank is also intending to introduce similar automation via robotics in some of their branches in near future. Now, to buttress the point, let us look at some statistics. As per annual report which we recently released, in volume terms, the share of electronic transactions in total transactions moved up to 84.4% from 74.6% in the previous year. In value terms, their share moved up to 95.2%, which was 94.6% last year. The National Electronic Fund Transfer, NEFT, facility was available through 1,30,013 branches of 172 banks. In addition to business correspondent outlets, NEFT handled 1.2 billion transactions valued at around rupees 83 trillion, that is $1.3 trillion. And it was 928 million transactions or rupees 60 trillion, that is $0.9 trillion in the previous year. In March 2016, NEFT processed the largest ever monthly volume of 129 million transactions. Internet banking and mobile banking based payments are increasing at a rapid pace. I have already mentioned about the UPI earlier. Now enrollment under Aadhaar, which is the unique identity identifier for resident in the country, it has already reached a significant milestone and could create potential for some kind of account number portability going forward, a subject on which I think I have mentioned several times on various platforms, that like mobile number portability, the account number portability can be very much a reality, and now with UPI and other combination, it is, I think, nearer than what we had anticipated. And this is where the banks have to be quite aware of the competition. Now, then there is always a risk of silent customer who would not complain, who would simply shift because there is no inconvenience now is involved. This can transform the banking sector in a way that cannot be fathomed now. Now, while everyone can appreciate the ease of doing banking transactions quickly and 24/7, the backbone for enabling such advanced technology-based solutions would be the IT architecture of the bank, quite obviously. Thus, to reap the fuller benefits of digital products that are being launched every day, the IT systems at banks need to be robust, capable of handling increasing volumes in secure manner, provide connectivity to various applications, accessing the bank's core banking solution in a safe manner, and at the same time ensure confidentiality of customer information. That is very, very important and crucial. Now, recognizing the challenge, Reserve Bank of India has been providing guidance to banks on managing the adoption of technology. One of the major initiatives of RBI was the setting up of a working group on information security, electronic banking, technology risk management, and cyber fraud. And the working group was headed by Mr. Gopal Krishna only, who is incidentally now again spearheading this particular conference. Now, the group examined various issues arising out of the use of information technology in banks and made its recommendation in 9 broad areas. And I think is a kind of very important reference paper, covers almost all those important areas. And those areas were IT governance, information security, IS audit, IT operations, IT services outsourcing, cyber fraud, business continuity planning, customer awareness program, and legal aspects. Those of you who have not have looked at the recommendations of this group should do now. It is a very important reference paper. The guidelines are not one size fits all, and the implementation of these recommendations need to be risk-based and commensurate with the nature and the scope of activities engaged by banks and the technology environment prevalent in the individual banks, and the support rendered by technology to the business processes. The guidelines were to be implemented by banks and to be monitored by their respective board level committees. While progress has been made in the past few years, I would tend to believe that banks have to travel a lot of distance before the requirements are fully met with. Given the role of technology in the functioning of banks today, I must say this is no longer a compliance matter, but is a core business issue, and it should be perceived in that way. Now, with computerization of various activities within a bank, as a regulator and supervisor, I expect that banks would now have much higher capacity to generate relevant management information for various decision-making purposes. Now, let me touch upon a few specific areas. Now, one of the primary areas of concern for the financial world is to ensure that the banking system is not abused by the unscrupulous element for money laundering purposes. Now, regulation on know your customer, anti-money laundering are robust across jurisdictions. However, often we find banks are not having robust system to fulfill the requirement. At the time of onboarding the customers, banks are required to understand their customers, their business and expected turnover in their account, source of such transactions, etc. We have seen in the recent time that several banks have allowed transactions in their customers' account without any reference to their declared business profiles. No questions were asked from the customers. The account received multiple RTGS, NEFT, inward transactions, and several remittances were sent out of these accounts as well. Several accounts were abused to send money abroad in the form of advance import remittances. Despite the disproportionate activity in such accounts, the monitoring mechanism of banks fell short of our expectation. I wonder why banks are not able to devise foolproof technological solutions. Obviously, this is something which cannot be handled or controlled manually. It has to be supervised with the use of technology. On several other forums, I have mentioned about that famous case of money muling in Punjab, where a credit of rupees 1 crore came into the account which was opened under one of the mass account opening program in a manual laborer's account, and then money was taken out. He only realized when he got a notice from income tax department demanding tax of 40 lakhs rupees on 1 crore credit, which is not explained. Very recently, I think last week, I have yet to confirm what are those details, but there was a news item in one of the local Mumbai newspaper mentioning about some 10 banks, and a number of transactions which have happened, and again the suspicion of this money laundering and money bullying, those kind of things, because it is mentioned in the news report that most of those account holders were from Islam area, and probably some money was paid just to use those accounts. So the risk categorization of such accounts were not reviewed periodically, and as you are aware that as a supervisory and regulatory process, we had to levy penalty on 13 banks for these lapses in the passage of last few months. Another area that comes to my mind is the system-based identification process for NPAs. We feel this area still has scope for improvement. While I appreciate that the banks use multiple systems, the rules are elaborate and at times qualitative, posing challenges to capture the parameters as part of the computerized system. However, with the progress in technology, this should have been fixed much earlier. What we expect is a robust system-based identification of NPAs, not only for the regulators' use, but also for the bank's internal use, so as to facilitate timely recovery and resolution. The third area that I would like to touch upon is the Automated Data Flow Project, ADF, as you are familiar, wherein it was envisaged that banks would draw various elements to be reported to the regulator in a systematic manner. I am told that ADF implementation has not progressed to the desired level. Despite significant technological progress, timeliness of data submission as well as the quality of such data leaves much to be desired. And banks should understand, as we have moved to the risk-based supervision, the input, the data and the quality of data which you provide for the purpose of supervision determines a large extent that how the risk profile of your bank is captured, what kind of ratings you get, and resultantly what kind of additional capital would be sought from you. So it is not a mere data submitting information. It has implications which go much beyond that. Now I can go on several such issues, but one common thread I see in all the above is the lack of board level involvement or oversight on these important areas, and commitment from the executive management. Technology service providers, particularly product vendors, also have a role to play. It is important that the technology they provide is capable of meeting the regulatory requirements on a continuous basis and gaps, if any, are addressed within a short span of time, and such upgrades are propagated to all the regulated entities in a seamless and cost-effective manner. Now, let me now turn towards some of the recent cyber incidents, the main topic of today's seminar, pertaining to the financial world. On 2nd August 2016, very recent, Bitfinex, a Hong Kong exchange for the trading of digital currencies, announced that some of these customer accounts were hacked and bitcoins were stolen. The value of the stolen bitcoins has been reported to be approximately $65 million or more. As a consequence, the value of bitcoins came down and the trust on the digital currency itself was shaken. In the another incident, in the beginning of the year, as you all know, Bangladesh Bank was the target and an attempt was made to steal almost $1 billion. And ultimately the attacker could succeed in getting away with $81 million. Recently in India too, a similar attempt was made on a commercial bank by generating fraudulent payment instructions on the Nostro account transmitted through SWIFT. Though no monetary loss was incurred due to proactive follow-up with the concerned paying and intermediary banks, the incident brought to the fore the fact that needed lessons have not been learned by various stakeholders. We have also come across instances of fraudulent messages confirming documentary credits being transmitted using SWIFT infrastructure. Although the later incidents were mainly a result of failure of internal controls and non-adherence to the 4 Eyes principle, it is also on account of reliance on disparate systems whereby SWIFT transaction could be done without a corresponding transactions happening in the core banking solution. This is what made it possible for those kind of documentary credit fraudulent transactions to happen. Now, in another incident involving shared mobile wallet of a bank, it was seen that there were vulnerabilities in the application itself that led to exploitation by the attackers. The originator of the transfer could get the amount reversed back to him without corresponding debit in the recipient's account in large number of transactions. The total amount involved was around ₹12 crore. Bank was not performing any real-time reconciliation and noticed it only when there was a spike in transactions which led to detection during reconciliation. The vulnerabilities exploited in the incident could have been averted had the launch of the product not been rushed through by giving a go-by to robust testing or by ignoring the corrective measures identified by testing process. At times, in the rush of competition, in the rush to introduce a project first in the market, sometimes these basic fundamental checks and balances are ignored, I think, which can prove very costly. In another incident, an e-payment validation website of a large bank was hacked very recently, just a couple of months back. And what is very disappointing is that the bank was not aware of the incident till it was notified by a law enforcement agency. There was a Facebook post by a person from a neighboring country claiming responsibility for the operation. The hacking did not result in any pecuniary loss, as the site attacked was only performing validations of input entered by end users. Now, as may be seen from the various incidents which I have narrated here, the threat landscape is widening. This is natural given that the money no longer moves only in physical form, but mostly through electronic means. And where money is there, it is to be expected that unscrupulous elements would find ways to steal. It happens right from the Kautilya's time. Those of you must have read the Arthashastra. He has described several ways, I think 40 or so ways, how to steal the money. So these are the now latest addition to the list. Now, one of the key targets by the attackers is the credential of the customers, as it provides the key to the khajana, proverbial treasure. Now the actors in this activity include organized gangs and nation-state actors having huge financial backing. On the other hand, the cost of orchestrating such attacks is coming down. There are several reports indicating availability of credential of customers for sale in dark web, and I think this is something which is really scary. Now, internationally, the focus has now shifted to cyber security. Cyber security is no longer an isolated incident affecting one industry or one country. This has assumed global proportion and has an important bearing on financial stability. This could be gauged from the fact that several international standard-setting bodies as well as reputed central banks have focused their attention to address the issue. Several cyber attacks in recent times have been designed to achieve political, religious objectives, as also for securing funds for promoting terrorism. And I think these are the very larger and frightening dimension of the activities which are happening in the cyberspace. Several countries have taken important steps to improve their cyber resilience. Committee on Payment and Market Infrastructure and Board of the International Organization of Security Commissions, IOSCO and CPMI. They have issued the guidance on cyber resilience for financial market infrastructure in June 2016 after consultation with various stakeholders. Financial Policy Committee of Bank of England launched the CBEST, C-based initiative, a vulnerability testing framework. Following their meeting in June 2013, the FPC issued a recommendation requesting that Her Majesty's Treasury and the regulators work with the core of the UK financial system and its infrastructure to put in place a program of work to improve and test resilience to cyber attack. The committee also noted that it was important that boards of financial firms and infrastructure providers recognize their responsibility for responding to those attacks. Recently, in May 2016, Hong Kong Monetary Authority launched a cyber security fortification initiative, which is known as CFI in short. Now, CFI consists of three pillars. One, cyber resilience assessment framework. Two, professional development program. And third, cyber intelligence sharing platform. That's something which I touched upon in my opening paragraph. In India, we have recognized the importance of cyber security and have been working on strengthening the defenses. Government of India has taken several steps to tackle the menace of cyber attacks, and important institutional arrangements have been made. Indian Computer Emergency Response Team, S13, as commonly known, has been established, which monitors Indian cyberspace and coordinates alerts and warning of imminent attacks and detection of malicious attacks among public and private cyber users and organizations in the country. Bank financial institutions have been identified as critical infrastructure for the purpose. A National Cyber Coordination Center has also been established. The Reserve Bank of India has issued instructions on cyber security framework to banks on June 2016. I am sure many of you would have had a chance to look at the instructions. Among other things, this circular expects banks to put in place a board-approved cyber security policy, to prepare a cyber crisis management plan, to make arrangement for continuous surveillance, and I think there is a whole list is there. Subsequent to that, the Reserve Bank has also set up an expert panel on IT examination and cyber security, which is chaired by our Executive Director, Meena Hemchandra. and it has drawn experts from the industry as members. The panel is providing assistance in IT examination, cyber security initiative of banks, review examination reports, and suggest actionable items. Now, accordingly, a detailed IT examination program was launched in October 2015. We started with two banks, one in the private sector space, one in the public sector space. Now, in the current year, it is proposed to roll out the IT examination in 30 plus major banks during the current supervisory cycle of 2016-17. And by 17-18, we propose to expand it to all the banks, this special IT examination, in addition to the supervisory framework which is already in place. The Reserve Bank also proposes to set up a cyber security lab which will assist IT examiners in conducting analysis of cyber security of banks. On the other hand, the process of operationalizing the information technology subsidiary of the Reserve Bank is nearing completion, and Mr. Sarvade is sitting here, who is spearheading that organization and putting the necessary components in place. This will focus on IT systems and cyber security, including related research of the financial sector, and assist in the audit and assessment of the entities regulated by Reserve Bank of India. The mandate of RABIT also include advising, implementing, and managing the IT projects or systems of the Reserve Bank. Let me now share some of the expectations from banks. First and foremost, we expect the board of directors to get actively involved in the technology related aspects. IT strategy needs to be closely aligned with the business strategy. With strides in technology, it would be difficult for boards that do not have members having expertise in technology related areas to effectively adopt technology. Technology risk, including cyber risk, is to be treated just like any other inherent risk faced by the banks, namely credit, market, operational risk. And thus board needs to articulate what is their risk appetite, which residual risk they would like to carry, and what kind of mitigation strategy they would like to follow. In the name of technology adoption, while banks are proactive in procuring various latest gadgets, what we observe across institutions is that the configuration of such devices are seldom given sufficient importance, and it is left to the vendors. Vulnerabilities exist in hardware, middleware, software, operating system, applications, network devices, communication devices, etc. It is therefore important to pay sufficient attention while procuring or implementing any new devices or solutions. Cyber criminals are also increasingly exploiting the vulnerabilities of the smartphone software by infecting the operating system with malwares. The banks pushing on mobile banking must also look to guard against this kind of eventuality. Another area of concern, and we have seen in some of the incidents which I recently narrated, so this area of concern is the patch management. OEMs release patches after known vulnerabilities are escalated to them, and if the patches are not rolled out in time, they are practically leaving the door open for exploitation. User management leaves much to be desired, and these are all what we have seen. So, practice of shared password. Sometime in a lighter when I mentioned that password has become kind of pass the word, freely shared among a group of people. So, no password, free administrator level access, dated authorization user list are quite commonplace. Often there is no robust process for creating new users, reviewing the list, and deleting the inactive users. Then there is the issue of implementing physical security. I have seen physical security access control system being in place, but users not insisted upon. In fact, just on my way to this conference, I was having a look at today's newspaper, and there is a supplement on cyber risk in this newspaper. Interestingly, it is mentioning that this, how the very rudimentary security aspects are ignored. It is mentioned that in that very famous hacking of Sony international site by North Korea, what was found that the organization was keeping all the password in folder, and which was very bold letter, it was carrying a sticker password. So this is the status of such a rudimentary physical security aspect. Now further, the dependence on the vendors is increasing, and many a times only the vendor knows how the system is to be operated. And I think this is a very serious as well as sorry state of affairs. Customer information is stored at vendors' facilities without adequate safeguard. Another curious thing I note is that while the banks claim that they do not get skilled resources, the same vendor provides some critical services to multiple banks. This raises a question as to whether the banks know what they get from their outsourced vendors, including the quality of delivery. Timely decisions to scale up the capacity is very important to ensure continued availability of services and business growth. People and processes need to be given adequate importance, or without capable hands, even best of the system is bound to fail. Monitoring is paramount, whether the port that was opened for a specific purpose was closed in time, who analyzed the important logs that are created religiously, how incidents are responded to, whether the Security Operations Center SOC is integrated with input from various systems, whether the exception thrown out are escalated to appropriate levels, etc. As a practicing banker for a long period of my career, I know that simple document, ETR, exceptional transaction report, which is generated by every branch, even if that is to looked, with a diligence, many of the frauds could have been avoided. But the ETR is neatly filed. I think hardly one has a look at it. So, considering all this, the security culture at banks need to change for the better. In a brick and mortar environment, if the safe is not having good locking system, or the walls are showing some cracks, or the roof is leaking, banks do notice. In a digital world, is it not important to look at such leaks, cracks, and vulnerabilities and take appropriate action? Phishing attacks on customers are increasing. Is it not the responsibility of banks to educate their customers and build some workaround to prevent the fraudsters to escape so easily? Considering the inability of the customer to withstand organized electronic crimes, RBI has put in place a framework for limiting the liability of customers in unauthorized electronic banking transactions as a customer protection measure. We are very clear that when it comes to a benefit of doubt between an institution and individual, the benefit of doubt has to, undoubtedly it has to go to individual and not to the institution. And that is how we have put the framework. Now, similarly, whether it is technology service provider or SWIFT-like infrastructure provider, is it not the vendor's responsibility to ensure that their agents meet all the electronic security requirements at all times, and that the environment is secure enough to carry out the stated business? I feel society as a whole need to recognize the emerging digital landscape and do their bit to ensure that our digital world, while it brings convenience and comfort to all consumers, does not compromise on the security. In conclusion, I would just like to recapitulate some of my observations. One, cyber security has emerged as an important area of attention world over, particularly for the financial sector. Two, cyber incidents are increasingly shifting towards targeting a financial institution instead of end user. I think it is a very important shift and which is witnessed in recent past. Now, a manifestation of this trend is evident in Carbonac, I think the most widely known and discussed incident, which was a major advanced persistent threat attack against financial institutions around the world. The surprise factor in this APT attack was the criminals' change in approach and careful planning, whereby rather than using the usual cyber criminal method of stealing consumer credentials or compromising individual online banking sessions with malware, the Kabana gang targeted banks' internal systems and operations and resulting in a multi-channel robbery that is estimated to be around $1 billion. Now, the third point which I want to make is cyber risk cannot be brought down to zero. This is a chase which will always continue, and it would be futile to believe that it can be completely eliminated at any point of time. Hence, a quick restoration plan with least damage post-breach is crucial. There is a need to evolve a blueprint of coordination between financial institutions and public authorities in such an eventuality. And I don't want to go into the detail, but dimensions can be frightening. See, today there are institutions like GC, the globally systematically important bank or GCPs, and it's quite possible. I would say one should allow sometimes the imagination to run riot. It's quite possible by this kind of activities or attack, one such institution can be brought to a condition of resolution. And if that were to happen, the contagion and what we have seen in 2008, those are all very frightening possibilities. So like post-2008 crisis, a framework has evolved. How to put orderly resolution, a living bill kind of thing. I think a similar coordination and clarity is needed in the area of the cyber security. If any such untoward incident were to happen, what should be the response strategy and how it should unfold? The pace of expansion of digital world is increasing, and hence technology adoption should be conscious, purposeful, and value-adding. For improving the IT security, the banks need to focus on increased staff, customer awareness, and training. And I think I would like to emphasize this point. All the system, all the technology, everything is fine, but end of the day, ultimately, it is the human element, which would always be very, very important. And I think that is something which cannot be, one cannot afford to be relaxed towards. Cautioning the staff and the customers to refrain from opening suspicious emails from unknown persons, entering personal account details on fake website, wishing, etc. can be effective first step in this endeavor. These all may appear like to be very rudimentary or very elementary kind of things, but we have seen in number of incidents that they were only the responsible for further manifestation of problem. While the financial sector has been ardently working for decades to prevent fraud and strengthen the detection and protection mechanism, the threats to their internal operations network has been considered to be low until attacks like Banak happened. Under the emerging circumstances, the banks need to be mindful of likely attacks from within the bank's internal core systems and try to plug such vulnerabilities. Banks need to practice cyber hygiene, and I hope the board and top management develop early sensitivity to this important task. The CISO also has a very important role in supporting the board and senior management in this initiative by focusing on IT governance, information security audit, and the customer communication, fraud management, and legal aspects. Our view is that CISO's role need to be enhanced from an operational level to a strategic level. With this, I conclude, and I wish this seminar all the success, and I hope that the deliberations and the points coming out of this seminar would be helpful for the entire industry as well as for the RBI as a regulator